This is a 20-year historical view of the stock market, the Dow Jones Industrial Average to be more specific. And this global pandemic that we're going through right now is the third recession that we've had in the past 20 years. What's really interesting to see is that after every recession period, the stock market has climbed back up to hit all-time record highs. This has been true since the beginning of the stock market. And since a recession occurs on average every 4 to 6 years, if you take a step back and look at the market from a holistic long-term investor standpoint, every 4 to 6 years you're presented with a great opportunity to capitalize on a market decline and optimize your investment positions. So today, I'm going to share with you guys my personal investment strategy for when a recession occurs, to rebalance my portfolio, to improve my investment positions, and to set myself up for maximum profit gain whenever we exit the decline period in the market and enter a new phase of growth within the economy. So let's dive into it. Welcome back to Daniel's Brew, where I talk personal finance, investing, and career growth, all while drinking a cup of coffee. So in the heart of this video, we're going to be covering three main topics: the truths and facts about recessions. There are some key things that you need to know about a declining period in the market that'll form the foundation of our strategy. Then the core tactics of the strategy itself. And third, what securities you should pick when employing this strategy. So starting off with the first topic, there are 6 key foundational things that you need to know about recessions in general. First, let's define what a recession is. In the US, the National Bureau of Economic Research is the entity that officially designates whether or not a bear market is a recession. How they define the event is a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. Regarding this current global pandemic period that we're in, last week on June 8, 2020, this organization officially stated that the unprecedented magnitude of the decline in employment and production and its broad reach across the entire economy warrants the designation of this episode as a recession, even if it turns out to be briefer than earlier contractions. So anytime we see a sharp drop in GDP, employment, production, and sales for a period of more than a few months, that's a good indication that a recession might have begun. The next thing you need to know about recessions is that they happen every 4 to 6 years, as I mentioned earlier. Take a look at this historical chart of US recessions from a Business Insider article. All of the gray vertical bars indicate time periods where the US was in a technical definition of a recession. Now, of course, you might not have heard of all of these because some of these were short and not as notable as some of the other major ones, like the dot-com bust of the early 2000s or the Great Financial Crisis of 2008, but they all happened and they were all classified as recessions. Now, during a recession, it's typical to see a stock market pullback in the area of 35 to 45%. Of course, it varies slightly based on what index you're tracking, but if you look at the 3 major US market indices, the Dow Jones, the S&P 500, and the Nasdaq Composite, they've all behaved in a similar fashion. Let's go back to the chart and overlay the percentage declines that we've had in the past recessions. If we average out the stock market declines for these periods broadly, then we can surmise that from the results of the most recent experiences, on average, a recession results in about a 43% decline. And yes, I know that time periods and durations of the recessions were all different, but this is just a broad average for directional purposes. Now, the next thing that we need to know is how long a recession lasts on average. If we broadly average out the last 2 major recessions, then the mean comes out to be about 2 years and 1 month. Or if you look across the past 150 years, that average is more like 22 months, according to the National Bureau of Economic Research. The next piece of information to know about recessions is what the average recovery curve looks like. Financial analysts usually talk about these 3 types of recovery curves: a V, where the stock market rebounds almost immediately after hitting the lows for the period; a U, where the recovery is more gradual and there's roughly an equal amount of time spent in both the decline slope and the recovery slope; and an L, where the recovery takes a significantly longer time than the initial decline period. For context, the recession in the early 2000s was kind of a U. The financial crash of 2008 was more like a long L that lasted almost 5 years, and this current global pandemic is looking like it might just be a straight V. And lastly, we have to keep in mind that the growth period following a recession usually results in a large multiple gain in the stock market compared to the amount of the decline. In the early 2000s, the Dow gained 94% after the recession, and starting from 2009, we saw the longest bull market in history of 11 years, where the Dow gained 351% from its previous recession lows. Alright, now let's move on to the trading strategy that I employ during a recession period. But before I go any further, I want to make sure that I clearly state these caveats. First, I'm not a professional financial advisor, or a Series 6 broker, or even a professor of economics. I'm just a regular retail investor that's found a strategy that's worked for me. Also, these tactics that I employ in this strategy are advanced trading tactics that I definitely wouldn't recommend if you're new to trading or investing. The methodology I employ is pretty risky, and if you don't know exactly what you're doing, you could end up losing a lot of money quickly. I'm sharing my thoughts and strategies with you guys to show you one perspective on how to trade during a recession. But it's your responsibility to decide what financial decisions you want to make according to your own risk tolerance and situation. Cool? Alright, so with that out of the way, as a beginning to the explanation of this strategy, I want to first define the benchmark that we're going to be comparing against. The safest and the most conservative thing that you can do during a time of recession is to simply do nothing and hold. As history has shown us, after every recession period, the stock market always recovers 100% of its losses and eventually goes on to hit new record highs. So if you have confidence that the future performance of the stock market will be consistent with the past, the most prudent thing that you can do is to hold on to your assets and simply wait for the market to recover. And as I mentioned before, if you don't know what you're doing, then trading in the midst of a stock market crash is one of the quickest ways to lose all of your capital. So if you're new to trading or investing, I'd highly recommend that you take the safer approach of just holding onto your assets and waiting out the recession. But if you do have some market experience and would like to use recessions as an opportunity to do better than the benchmark method of just holding, then keep watching. So moving on, let's define the objective of this trading strategy. In a recession, almost everyone loses money. And since no one can predict the exact point in time in which a recession will begin, nor can anyone predict the bottom of a recession period, any person or strategy claiming that they can time the market is pretty much a fraud. And that's not what this is. The objective of this strategy is to sell as close to the beginning point of the decline as possible, and then simply buy back into the market at a lower point than when you sold. It sounds simple, and maybe even insubstantial, but let me show you guys the depth of the strategy as I walk you guys through the execution. Step 1. Always have a trailing stop set for your holdings at an 11% decline. You see, the first step in this strategy is to exit as close to the start of the market decline as possible. Remember when we discussed that a recession causes a 35 to 45% decline in the stock market? What you want to do is exit at a point where there's definite confirmation of a sharp decline in the market, thereby signaling the potential start of a recession period, but is early enough to where you haven't seen anything like a 30% drop in the market yet. Now, some of you guys might ask, but why 11%? Why not 8% or 13%? Why 11 specifically? Well, a couple of reasons. First, a typical down day in the market can range anywhere between a 3% and a 5% daily drop. So if you set it too low, then you might get stopped out too early. But if you have a trailing stop set at 11%, then that means you'd have to have at least 3 consecutive down days or 3 closely spaced down days in a short period of time to hit that trigger. And if that happens, then that's definitely out of the norm and cause for some concern. Remember, you want to get as close to a solid confirmation of the beginning period of the recession as possible. And an 11% drop is enough confirmation to do that without risking a premature exit. So let's take our current recession here as an example of how this would have instantiated. I'm going to be using just the Dow Jones Industrial Average within these examples, but we'll get to the actual securities you'll want to invest in at a later time in the video. So let's say my total investments equaled $50,000 at the peak of the Dow on February 12, 2020 at 29,551 points. So a trailing stop of 11% would have hit on February 27, 2020, as the Dow crossed below 26,300 to hit the low of 25,752 of that day. Step 2. Recover your lost 11% by utilizing a triple leveraged inverse ETF. Now, if that initial 11% decline is an accurate signal of the start of a recession period, then we know from historical performance that the stock market has another probable 20 to 25% drop before it reaches the bottom. So what we want to do here is take advantage of a triple leveraged inverse ETF to recover the initial trailing stop loss of 11% and bring us back to our hold position. Now, if you're not familiar with leveraged or inverse ETFs, make sure you check out this video here to get a full understanding of these advanced investment vehicles before you engage in this step. So as you guys know, in order to recover the principal amount of an initial loss with a triple leveraged inverse ETF, you only need to invest another third of the original principal value. In the case of our example, our original investment was $50,000. So if we invest only a third of that, which is $16,667 in a triple leveraged inverse ETF, if the market drops another 11%, then we would have recovered the full $5,500 that we've lost. So we buy into a triple leveraged inverse ETF and set the limit sell at 22,919. In our current recession period, that order would have executed on March 12th when the Dow opened at 22,184. Effectively, what we've done here is retained our initial investment value but moved our potential market position down to match the decline of the market. Now for step 3, once we're in this position, we need to now evaluate how far the market has come down holistically and determine how much more we think the market has to go before we see a bottom. Now, remember back when we discussed that a typical market decline in a recession results in a 35 to 45% drop? At this point, we've seen the market contract about 22%, so we may only see about 10% more in decline before we see the recession floor. But since none of us can predict what the low period would be, at this point in the strategy, we're going to set a buy limit at 5% lower than the current market price. So that would be a 2174 point position in the Dow for our example. So why 5%? Because a 5% drop here represents a total 27% drop in the market from the peak. The key here is that you want to make sure that you enter the market at this point and not miss out in case we've already hit the bottom and there's a rebound that happens next. So if the market typically drops 35 to 45% in a recession, then setting up a re-entry point at a 27% drop is a safe way to guarantee that you'll get into position before the market rebounds. At this point, it's better to get in quickly rather than trying to time the bottom and missing out and then subsequently chasing a market run-up. So going back to our example, with this step, we would have entered in our position here on March 16th when the Dow opened at 2917. Now just a side note here, if you wanted to, you could enter a half position here and wait to see if the market goes up or down and invest the remaining half then. But just remember that if it does end up going up, you'd be dollar cost averaging into a higher position than if you had just entered into a full position at the 27% decline point. And step 4, now you wait. At this stage, you're fully invested back into the market and it's just a waiting game for the market to recover and for you to see how much you've gained in your portfolio. Let's play out the rest of the market action up to this point. The Dow continues lower until March 23rd when it touches the lowest point at 18,213. Then by March 25th, the Dow climbs back up to the levels in which we re-entered the market in step 3. So from that point on, in the case of our current recession, as of June 15th, the stock market is now showing a seemingly V-shaped recovery, with the Dow rising 22% from its bottom in just 3 months. Now that works out great for this current example in 2020, but you might be wondering, how would it have fared if we applied this strategy to other recessions, like the financial crash of 2008? Well, let's take a look together. October 9th, 2007, the Dow Jones hits an all-time record high of 14,164. Step 1. An 11% trailing stop order executes on January 8th as the Dow crosses below 12,605. Step 2. A triple leverage inverse ETF is bought and held until the sell order executes on July 1st of 2008, when the Dow crosses below 11,219. Step 3. Re-entry into the market at a full position happens on September 17th, 2008, as the Dow crosses below 10,658. Step 4. In this particular example, it's a test of patience, because as we saw earlier, the financial crash of 2008 was a much longer L-shaped recovery that took nearly 5 years for the Dow to climb back up to the levels it was at previously. But if you had the patience and follow the guidelines of this strategy, then on February 28th of 2013, when the market reached back to the previous high back in October 9th, your gain would have been 32% from your re-entry point back in September 17th of 2008. At step 4, it's really just a waiting game. And again, this strategy is designed to put you in a better position to profit from the recession in the long run. And also remember that our benchmark is doing nothing and holding through the recession. At this point, if you had kept that benchmark strategy, your investments would be back to even at a point before the recession occurred, as opposed to being 32% positive. But I will be honest, the longer a recession goes, the harder it is to keep steady on step 4. But in the long run, following a set strategy is always a better option than trying to play the market by gut feeling. Lastly, what are the different securities you should invest in as we employ this recession profiting strategy? For the leveraged inverse ETFs, these are a few of the ones that I've employed in my personal trading orders. I try to stay with the market index ETFs as much as possible, as opposed to a particular niche or sector ETF, because I want to make sure that I ride the wave of the entire market, either up or down. In terms of what I would invest in on the re-entry, I typically rebalance my portfolio with a mix of 35% index mutual funds, 45% stocks, and 20% ETFs. Here's what I'm currently holding at the moment. In a separate video, I can go over why I choose certain stocks and what my holding strategy is. But for now, since this video is already turning out to be a bit long, we'll move on. So I hope this has helped provide one perspective on how you can trade in a recession period. And if you enjoyed this video, please make sure you smash that like button. And don't forget to subscribe and hit the notification icon as well, so you don't miss other videos like this in the future. And remember, this is just one retail trader's personal strategy. So make sure you take all of this in with a grain of salt and make your own financial and investment decisions based on your own individual risk tolerance and situation. So thanks for joining me today on Daniel's Brew, and we'll see you next time.